pivoting the conversation just a bit and focusing maybe on the econ data that we have been getting out over the last several weeks. And earlier this week, as part of our morning brief newsletter, our chart of the day was on Citi's economic surprise index here and what you guys have been seeing. And for those who maybe aren't familiar with it, it measures just the rate, I guess, that some of that econ data is coming in better than expected, but it's actually hit its lowest level that we've seen in more than a year. I'm curious what that signals to you and maybe what investors should be sussing out from that reading in terms of where we could be heading or some of those risks.
Yeah, I mean, I think we try to balance the surprise with the underlying level of growth. So I think what you've seen, the reason surprise has gotten negative, I think, is because consensus has revised up their numbers as the recession hasn't materialized. So you kind of set a higher bar from consensus. Now the data has been coming in below that higher bar since early May. So it's concerning, just in the sense you have negative surprise on hard economic data, and that's the stuff that would go into GDP, as well as like soft economic data, which is more your survey stuff. The level of growth has also slowed, but it still remains kind of solidly positive. So I think now you're looking at that surprise data and you're saying, all right, maybe expectations got a little ahead of themselves, or maybe I'm getting a little warning sign here that I should prepare for a deceleration. From an investor's perspective, that just tells us risk reward kind of isn't as clean as it was early in the year, because we went from a period of low expectations with data coming in better than expected to now higher expectations with data coming in a little bit worse. And I think you just have to respect that and say, maybe this is a time for me to be patient when I'm looking at things.
So what's the next big data point that you think will be the big catalyst for the market? Is it going to be PCE, or are you looking to labor as always?
I mean, PCE matters just because it matters to the Fed. The fact is we have PPI and CPI already, so the market has a pretty good idea of where that PCE number is going to come in most likely. Labor market for us is the key to the markets. Our general view is you want to run long your U.S. equity portfolio unless and until you get a significant slowdown in payrolls. And by payrolls, I mean, non-farm payrolls and claims. There's a lot of little, cracks under the surface and more nuanced measures of labor. But yeah, for us, it's payrolls next Friday, unfortunately, the day after the 4th, which is unfriendly.
Tough for you and your team, right, Stuart? Yeah.
Well, it's a Go America moment, so we'll just hope the data comes in strong.
There we go. Stuart, it's great to have you. Thanks so much for making the time to join us here in studio. Stuart Kaiser, he's Citi's head of equity trading strategy. Thanks again.
Thank you.